I want to talk to you today about something I have witnessed over and over again in my 80 plus years of investing, a pattern that repeats itself with such regularity that once you understand it, you can position your portfolio to benefit enormously. I am talking about what happens before interest rates crash. And I do not use that word lightly. Crash. Not decline gradually, not drift lower over years, but crash suddenly and dramatically in a short period of time. I have lived through multiple interest rate cycles. I watched rates climb steadily through the 1950s and 60s as post-war economic growth drove inflation higher. I watched them explode to unprecedented levels in the late 70s and early 80s under Paul Volcker as the Federal Reserve fought to break the back of double-digit inflation. I watched them collapse in the early 90s recession. I watched them plummet to zero after the 2008 financial crisis, and I watched them crater again during the COVID pandemic in 2020. Each time there was a pattern, a sequence of events that unfolded in a predictable way, warning signs that appeared months or even years before rates actually crashed, economic conditions that created the inevitable setup for the Federal Reserve to cut rates aggressively. And most importantly for investors, specific asset classes and sectors that performed extraordinarily well when you could see the crash coming and position accordingly. Today, I am going to share with you what I have learned from watching this pattern repeat itself over 8 decades. I am going to tell you exactly what always happens before interest rates crash. I am going to show you the warning signs to watch for. I am going to explain the economic mechanisms that drive the pattern. And I am going to give you a playbook for how to position your portfolio when you see these signs emerging, because I believe we may be approaching another one of these inflection points right now, and understanding this pattern could be the difference between making a fortune and getting crushed. Let me start by explaining what I mean by an interest rate crash. I am not talking about the Federal Reserve cutting rates by a quarter point at a scheduled meeting. That is normal monetary policy adjustment. I am talking about dramatic, rapid cuts that happen in response to economic distress, going from 5% Fed funds rate to 1% in a matter of months, going from 1% to zero, emergency cuts between scheduled meetings, multiple 50 or even 75 basis point cuts in rapid succession. This is crisis mode. This is the Fed panicking and trying to prevent economic catastrophe. These crashes do not happen randomly. They happen at very specific moments in the economic cycle. And if you know what to look for, you can see them coming months or even a year in advance. Not with certainty, because nothing in economics is certain, but with high enough probability that you can position your portfolio to benefit while managing your downside risk if you are wrong. The pattern always starts the same way. The economy has been growing for an extended period, multiple years, sometimes a full decade. Employment is strong, corporate profits are healthy, stock prices have been rising, consumer confidence is high.
The Federal Reserve has been gradually raising interest rates to prevent the economy from overheating and to keep inflation in check. This is the expansion phase of the business cycle, and it can last a very long time.
During this expansion, something important happens that most people do not pay attention to. The yield curve inverts. Let me explain what this means, because it is absolutely critical to understanding the pattern. The yield curve is the relationship between short-term interest rates and long-term interest rates. Under normal conditions, long-term rates are higher than short-term rates. If you lend money for 10 years, you demand a higher interest rate than if you lend for 2 years, because you are taking more risk. Your money is locked up longer. More things can go wrong. Inflation could accelerate. The borrower could default. So you demand compensation for that additional risk. A normal yield curve slopes upward. 2-year Treasury yields might be 3%. 10-year Treasury yields might be 4%. The curve is positive. But sometimes during the late stages of an expansion, when the Fed has been raising short-term rates aggressively to fight inflation or cool the economy, something unusual happens. Short-term rates rise above long-term rates. The 2-year Treasury might yield 4%, while the 10-year yields only 3.5%. The curve inverts. It slopes downward instead of upward. This inversion is one of the most reliable recession indicators in all of economics. And I want to emphasize this because it is so important. Every single recession in the past 70 years has been preceded by a yield curve inversion. Every single one. There have been no false positives where the curve inverted and a recession did not follow. The only question when you see an inversion is not whether a recession is coming, but when it will arrive and how severe it will be. Why does the yield curve invert before recessions? The mechanism is straightforward once you understand it. The Fed raises short-term rates to slow the economy. Banks and money market funds offer higher yields on short-term deposits and treasury bills. Meanwhile, long-term bond investors look ahead and see the economy slowing. They expect that the Fed will eventually need to cut rates when the economy weakens, so they buy long-term bonds, which locks in current rates before they fall. This buying drives long-term bond prices up and yields down. Short-term rates keep rising from Fed hikes. Long-term rates fall from investor demand. The curve inverts. The inversion itself does not cause the recession. It is a symptom of the economic conditions that will lead to the recession. The Fed has tightened monetary policy too much. Credit conditions have become restrictive. Borrowing costs are high. Consumer spending slows. Business investment declines. Economic growth decelerates. And eventually, something breaks. A sector of the economy that was over-leveraged cannot service its debt at higher rates. Defaults increase. Layoffs begin. The economy tips into recession. And the Fed, seeing the deterioration, begins cutting rates to try to cushion the downturn. Here is the pattern I have observed. The yield curve inverts. This happens anywhere from 6 to 24 months before the recession actually begins. During this period after inversion, but before recession, the economy continues to grow, but at a slower pace. The stock market often keeps rising for a while because corporate earnings are still strong. This is the dangerous phase where most investors get complacent. They see the inverted curve but dismiss it. They say this time is different. They say the economy is resilient. They say the Fed has engineered a soft landing. They stay fully invested in risk assets. Then something happens. It is different each time in terms of specifics, but the pattern is the same. A crisis emerges. In 2008, it was the housing market and the financial system. In 2020, it was COVID. In 2001, it was the tech bubble bursting. In 1990, it was the savings and loan crisis. The crisis reveals that the economy is weaker than people thought. Credit has been too loose in some sector. Leverage has built up. Asset prices have been inflated by cheap money. And when conditions tighten, the whole structure becomes unstable. The Fed recognizes the danger and begins cutting rates. Not gradually, aggressively. They cut 50 basis points, then 50 more, then another 50. In extreme cases like 2008, they go to zero and implement quantitative easing. The rate cuts happen fast and furious. This is the crash in interest rates that I'm talking about, and it creates massive opportunities for investors who position correctly. Let me walk through a specific historical example to make this concrete. The 2008 financial crisis. The yield curve inverted in early 2006. The 2-year yield rose above the 10-year yield for the first time in years. This was a clear warning sign that a recession was coming. But the economy was still growing. The housing market was still booming. Stock prices were still rising. Most investors ignored the warning. Over the next 18 months, the economy continued to expand, but housing started to weaken. Subprime mortgages began defaulting. Bear Stearns hedge funds collapsed in summer 2007. Cracks were appearing. But the Fed was still concerned about inflation and only cut rates slowly at first. Then in 2008, the crisis accelerated. Bear Stearns failed in March. Lehman Brothers failed in September. The entire financial system nearly collapsed. The Fed went into full panic mode. They cut the Fed funds rate from 5.25% in September 2007 to zero by December 2008, from over 5% to zero in 15 months. That is an interest rate crash. Long-term Treasury yields also collapsed. The 10-year Treasury yield went from over 5% in mid-2007 to under 2% by late 2008. Investors fleeing risk piled into the safety of government bonds. Bond prices soared, and anyone who had owned long-duration treasuries made enormous returns. A 30-year Treasury bond gained over 40% in 2008, while the stock market fell nearly 40%. That is the power of positioning correctly before an interest rate crash. Let me give you another example. The COVID crash in 2020, the yield curve inverted in 2019. The economy was growing but slowing. The Fed had been raising rates through 2018, but reversed course and started cutting in mid-2019 when they saw economic weakness. Then COVID hit in early 2020. The economy shut down. The Fed cut rates from 1.5% to 0 in a matter of weeks. They implemented massive QE, buying trillions in bonds. Interest rates crashed, and once again, long-duration treasuries and other rate-sensitive assets performed extraordinarily well. Now, you might be thinking, Warren, I cannot predict when a crisis will hit. I cannot know that COVID is coming or that Lehman will fail. How can I position for an interest rate crash if I do not know when or how it will happen? And you are right. You cannot predict a specific catalyst, but you do not need to. You just need to recognize the setup. You need to see the yield curve inversion. You need to understand that a recession is coming at some point in the next 12 to 24 months. And you need to position your portfolio to benefit when rates eventually crash. Let me tell you exactly how I think about positioning for this scenario. There are several things that happen before interest rates crash that create opportunities. First and most obvious, the yield curve inverts. When I see the 2-year Treasury yield rise above the 10-year yield, I know a recession is probably 12 to 18 months away. This is my first signal to start preparing. What do I do when I see this signal? I start increasing my allocation to cash and short-term Treasury bills. This serves two purposes. First, it provides safety. Cash does not go down when stocks crash. Second, it provides dry powder to buy assets when they get cheap during the crisis. During the inversion period, short-term rates are high. So I am actually earning a good return on my cash while I wait. In late 2006 and early 2007, you could earn 5% on Treasury bills with zero risk. That is an attractive place to park money while you wait for opportunities. I also start shifting my bond holdings toward longer duration treasuries. When the yield curve is inverted, long-term bonds are yielding less than short-term bonds. This seems counterintuitive. Why would I buy a 10-year bond yielding 4% when I can buy a 2-year bond yielding 4.5%? Because I know that when the recession hits and the Fed cuts rates, that 10-year bond will appreciate significantly in price as yields fall. The 2-year bond will mature and I will have to reinvest at lower rates. The 10-year bond will generate capital gains that far exceed the slightly higher yield on the 2-year. Let me show you the math on this because it is important to understand. A 10-year Treasury bond with a 4% coupon trading at par has a duration of about 8 years. Duration measures how much the bond price changes when yields change. If yields fall 1%, the bond price rises about 8%. If yields fall 2%, the price rises about 16%. During the 2008 crisis, 10-year yields fell from over 5% to under 2%. That is a 3% decline in yields. A 10-year bond would have gained roughly 24% in price. Plus you collected the coupon. Total return over 30% while stocks fell 40%. This is why I love long-duration treasuries when I see a yield curve inversion. They provide massive asymmetric returns. If I am wrong and no recession happens, I still collect the coupon and the bond matures at par. My downside is limited. But if I am right and rates crash, the capital gains can be enormous. 30, 40, even 50% returns in a year or two. The second thing I do when I see the warning signs is I become more selective in my stock holdings. I do not sell everything and go to cash. That is market timing, and it rarely works. But I do start trimming positions in the most economically sensitive sectors, banks and financials that will get hit hard in a recession, retailers and consumer discretionary companies, industrials and materials, these sectors get crushed when the economy turns down. Instead, I increase my exposure to defensive sectors, utilities that generate steady cash flows regardless of the economy, consumer staples that sell products people need, even in recessions, healthcare companies that have non-discretionary demand. These sectors do not go up as much in bull markets, but they hold up much better in downturns. When everyone else is panicking and selling, I want to own things that are stable and predictable. I also look for companies with strong balance sheets and pricing power, companies that can weather a recession without cutting their dividends, companies that can maintain margins even when revenues decline, companies that will emerge from the recession stronger because weaker competitors fail. These are the kind of businesses that compound wealth over long periods because they survive and thrive through all economic conditions. The third thing that happens before interest rates crash is credit spreads widen. Let me explain what this means. Credit spreads are the difference between yields on corporate bonds and yields on equivalent maturity treasury bonds. A BBB-rated corporate bond might yield 5%, while a 10-year treasury yields 4%. The spread is 1%. This spread represents the additional yield investors demand to compensate for credit risk, the risk that the company might default. During economic expansions, when times are good, credit spreads narrow. Investors become complacent about risk. They accept lower spreads because defaults are rare and everyone is making money. Corporate bonds might trade at only 50 or 75 basis points above treasuries. But when a recession approaches, spreads start to widen. Defaults increase. Investors become more cautious. They demand higher yields to compensate for increased risk. Spreads might widen to 2%, 3%, or even 5% for lower quality debt. This spread widening is a warning sign that credit conditions are deteriorating, and it creates opportunity. When spreads are very wide during a crisis, investment-grade corporate bonds can yield 6, 7, even 8%. These are high-quality companies like Johnson & Johnson or Microsoft issuing bonds. The risk of default is very low, but panicked investors are selling everything, so yields spike. If you buy these bonds when spreads are at crisis levels and hold to maturity, you lock in very attractive returns with limited risk. I did this in 2008 and 2009. Investment-grade corporate bonds were yielding 7 to 9% at the depths of the crisis. I knew that high-quality companies would not default even in a severe recession. So I bought billions of dollars of corporate bonds. I collected the high coupons. The bonds appreciated in price as spreads narrowed when the crisis passed. And I made very attractive risk-adjusted returns. The fourth thing I watch for is changes in Fed rhetoric. The Fed does not cut rates randomly. They cut in response to economic weakness or financial stress. So before rates crash, you always see the Fed shifting their tone. They stop talking about fighting inflation, start talking about supporting growth. They stop emphasizing restrictive policy and start expressing concern about downside risks. This shift in rhetoric precedes actual rate cuts by several months. In late 2007, the Fed was still raising rates and warning about inflation. By mid-2007, their tone had shifted. They started acknowledging housing market weakness and financial stress. By September 2007, they began cutting rates. The rhetoric changed before the action. If you were paying attention, you could see it coming. Similarly, in 2019, the Fed had raised rates multiple times through 2018. They were talking about gradually normalizing policy. Then, in early 2019, the economy showed signs of slowing. The rhetoric shifted. By mid-2019, they were cutting rates. Again, the rhetorical shift preceded the action. When I hear the Fed start to sound dovish after a period of hawkishness, I know rate cuts are coming. I adjust my portfolio accordingly. I buy more long-duration bonds. I increase cash. I shift to defensive stocks. I prepare for the inevitable downturn. The fifth sign is deterioration in leading economic indicators. There are dozens of economic data points that lead the overall economy by several months. Initial unemployment claims, manufacturing PMI, housing starts, consumer confidence, yield curve shape, corporate profit margins, credit growth. These indicators turn down before the overall economy tips into recession. I watch these indicators carefully when I see several of them deteriorating simultaneously after a long expansion. I know we are in the late cycle. A recession is coming. The Fed will cut rates. I need to position defensively. This is not market timing based on guessing what the market will do tomorrow. This is strategic positioning based on observable economic trends that have predicted every recession for 70 years. Let me be very clear about something. I am not trying to time the market perfectly. I am not trying to sell at the exact top and buy at the exact bottom. That is impossible, and anyone who claims they can do it consistently is lying or deluded. What I am trying to do is recognize when the risk-reward setup has shifted dramatically against risk assets and in favor of safe assets, and when the probability of a severe downturn has increased from low to high based on multiple observable indicators. During normal times, when the yield curve is positive, the economy is healthy, the Fed is accommodative or neutral, and credit spreads are tight, I am comfortable being fully invested in stocks and corporate bonds. The expected returns on risk assets are high, and the probability of a crash is low. But when the yield curve inverts, the Fed is restrictive, credit spreads are widening, and economic indicators are weakening, the setup has changed. Now, the expected return on risk assets is much lower because a recession is likely, and the expected return on defensive assets like treasuries is much higher because rates will fall during the recession. This is not market timing. This is risk management. This is common sense. You increase your exposure to risk when you are being compensated for it. You decrease exposure when you are not. Right now, if the yield curve is inverted and recession indicators are flashing, you are not being compensated to take risk. Stock valuations are elevated, credit spreads are tight, the Fed is restrictive. Why would you be aggressively long risk assets in that environment? It makes no sense. Instead, you shift to defense. You own more cash earning 5% on T-bills. You own long duration treasuries that will rally when rates fall. You own defensive stocks that will hold up in a recession. You position for what is likely to happen based on the pattern that has repeated itself over and over for decades. Now let me talk about what happens after interest rates crash and how to position for the recovery, because understanding the full cycle is important. Rates do not stay at zero forever. Eventually, the economy recovers, the Fed starts raising rates again, and a new expansion begins. If you can position correctly, both for the crash and for the recovery, you can compound wealth at exceptional rates. When the Fed cuts rates to zero and implements QE, as they did in 2008 and 2020, this creates the conditions for an eventual recovery and new bull market. The massive monetary stimulus floods the financial system with liquidity, asset prices stop falling and eventually start rising, credit spreads narrow from extreme levels, the stock market bottoms and begins a new bull run. The key is to recognize when we have moved from the crash phase to the early recovery phase. This usually happens when credit spreads stop widening and start narrowing. When high-yield bond spreads peak at 8, 10, 12% and then start falling, that is a sign that credit conditions are improving. When investment-grade spreads fall from 3% back toward 1%, that tells you the panic is subsiding. This is when I start shifting from defense back to offense. I sell some of my long-duration treasuries, locking in the capital gains from falling yields. I redeploy that capital into stocks, particularly in the sectors that were most beaten down. Financials that are trading at huge discounts to book value. Retailers that survived but saw their stocks cut in half. Industrials trading at single-digit earnings multiples. I also buy corporate bonds when spreads are at crisis levels. High-quality investment-grade bonds yielding 7 or 8% are gifts. I buy them knowing that even if the company struggles, they are unlikely to default. I collect the high coupons. The bonds appreciate as spreads normalize, and I make 15, 20, even 30% returns with much less risk than stocks. The 2008 crisis is a perfect example of this playbook in action. The yield curve inverted in 2006. I started building cash and buying treasuries. The crisis hit in 2008. Rates crashed. My treasuries soared in value. credit spreads blew out. I started buying investment-grade corporate bonds and high-quality dividend stocks at distressed prices. By 2009, the recovery was beginning. I had generated huge returns from the Treasury rally. I had locked in high yields on corporate bonds, and I owned stocks that quintupled over the next decade. And this is the power of understanding the pattern. You see the warning signs, you position defensively, you profit from the rate crash, you redeploy into risk assets at crisis prices, you ride the recovery, and you end up far wealthier than if you had just stayed fully invested the whole time and suffered through the 50% drawdown. Let me address some common objections to this approach. First, people say that yield curve inversions do not always lead to immediate recessions. Sometimes there is a lag of 2 years. How do you know when to position and for how long? My answer is that you do not need to know the exact timing. You start positioning when you see the inversion. You maintain that defensive posture until either a recession occurs or the inversion reverses and the economy reaccelerates. If you are wrong and no recession happens, you still earn good returns on your T-bills and long-duration treasuries. Your downside is limited. Second, people say that being defensive means you miss out on stock market gains if the expansion continues. That is true. In 2006 and 2007, after the inversion, stocks continued rising for over a year. If you went fully defensive in early 2006, you missed those gains. But then you avoided the 50% crash in 2008. Over the full cycle, you came out way ahead. I am willing to give up some upside in the late stages of a bull market to avoid catastrophic losses in the subsequent bear market. Third, people say this is market timing, and market timing does not work. I disagree with the premise. What I am describing is not market timing. Market timing is trying to predict short-term moves based on technical analysis or sentiment or gut feel. What I am describing is strategic asset allocation based on observable economic fundamentals and historically reliable patterns. The yield curve has predicted every recession for 70 years. That is not timing. That is paying attention to data. Fourth, people say that this time is different. The economy is stronger. The Fed is smarter. The financial system is more resilient. Whatever the rationalization, the conclusion is always the same. The old patterns do not apply anymore. And every single time they are wrong. 2006, people said housing prices never decline nationally. Wrong. 2019, people said the expansion could last forever with low inflation. Then COVID hit. The pattern always repeats because the underlying economic mechanisms do not change. Now let me talk about where we are today and what the current environment tells us about the probability of an interest rate crash in the near future. As I speak to you, the Federal Reserve has raised rates from near zero in 2021 to over 5% in 2023. This is one of the fastest tightening cycles in history. The yield curve inverted in 2022. It has been inverted for over a year, one of the longest inversions in history. According to the pattern I have described, a recession should be coming. The yield curve has inverted. The Fed has tightened aggressively. Credit conditions have tightened. Some leading indicators like manufacturing PMI have weakened. The setup is in place for an eventual downturn and interest rate crash. However, the economy has been more resilient than expected. Employment remains strong. Consumer spending has held up. Corporate earnings have been decent. This has led many to believe that this time is different, that the Fed has engineered a soft landing, that no recession is coming. I have heard this before. It is always wrong. The lag between the yield curve inversion and recession can be long, sometimes 2 years, but the recession always comes. My base case is that we will see a recession at some point in the next 12 months. When it hits, the Fed will cut rates aggressively. We could easily see rates go from 5% to 2 or 3%, possibly even back to zero if the recession is severe. This would be an interest rate crash, and it would create the same opportunities I have described. How am I positioning Berkshire for this scenario? We are holding record levels of cash and short-term treasuries, over $150 billion, earning 5% with zero risk. This gives us dry powder and earns a good return while we wait. I have been a net seller of stocks, trimming positions and raising cash. I have been selective about new investments, focusing on companies that can weather a recession. I own long-duration treasuries that will appreciate if rates fall. And I am prepared to deploy capital aggressively when credit spreads blow out and stock prices crash. Am I certain a recession is coming? No, nothing is certain in economics or investing, but the probability is high based on the historical pattern. And I would rather position for what is likely and be wrong than position for what is unlikely and be caught unprepared. The setup is there. The yield curve is inverted. The Fed is tightened. Economic growth is slowing. At some point, something will break. And when it does, rates will crash. For individual investors, here is what I recommend based on the current environment. First, increase your cash position. If you normally hold 5% cash, move to 10 or 15%. Use that cash to buy short-term T-bills earning 5%. This is not dead money. It is earning a solid return with zero risk while providing optionality. Second, extend the duration of your bond holdings. If you own a short-term bond fund or individual bonds maturing in 1 to 3 years, consider shifting to intermediate or long-term bonds. A 10-year treasury yielding 4% will appreciate significantly if we get rate cuts. A 2-year treasury will not. The extra duration is where the money is made when rates crash. Third, reduce exposure to the most economically sensitive stocks. You do not need to sell everything, but maybe trim some cyclicals and reallocate to defensives. Reduce financials, consumer discretionary industrials, increase utilities, consumer staples, healthcare, shift toward quality and away from leverage. Fourth, look for opportunities in investment-grade corporate bonds if spreads widen. Right now, spreads are relatively tight because credit conditions are still okay. But if we get a recession and spreads blow out, high-quality corporate bonds at 7 or 8% yields will be fantastic investments. Fifth, be patient and disciplined. Do not panic if I am wrong and the economy continues growing for another year. Your cash is earning 5%. Your defensive stocks are paying dividends. You are not suffering, but you are positioned to benefit enormously if the pattern plays out, as it has so many times before. Let me close with a story that illustrates the power of understanding this pattern. In the early 2000s, I saw the housing bubble building. I saw subprime lending going crazy. I saw the yield curve invert in 2006. I knew a crisis was coming. I did not know it would be as severe as it was. I did not know Lehman would fail, but I knew the setup was there for a major downturn. So I positioned Berkshire defensively. I raised cash. I bought long-term treasuries. I avoided financial stocks, even though they looked cheap on P/E ratios. And when the crisis hit in 2008, I was ready. While others were panicking and forced to sell at fire sale prices, I was buying. I bought Goldman Sachs preferred stock at terms that were incredibly favorable to Berkshire. I bought General Electric preferred stock. I bought investment-grade corporate bonds yielding 8 and 9%. I bought high-quality stocks at 50% discounts. The returns I generated for Berkshire shareholders from 2008 to 2010 were exceptional, not because I am smarter than everyone else, but because I understood the pattern. I saw the warning signs, I positioned appropriately, and I had the cash and courage to buy when everyone else was selling. That is the playbook. That is what always happens before interest rates crash. And that is how you profit from understanding the pattern. We may be approaching another one of these inflection points. The warning signs are there. The yield curve is inverted. The Fed is tightened aggressively. Economic growth is slowing. Credit conditions are tightening. It may take 6 months or 12 months or even longer for the recession to hit. But if history is any guide, it is coming. And when it does, interest rates will crash. The Fed will cut from 5% to 2% or lower. Long-term bond yields will fall. Credit spreads will blow out and then normalize. Stock prices will decline and then recover. If you position correctly, this creates the opportunity of a decade. You protect capital during the downturn by owning cash and treasuries. You profit from falling rates, and you redeploy into risk assets at depressed prices to ride the recovery. This is how generational wealth is built, not by staying fully invested at all times and riding every wave up and down, but by recognizing when the risk-reward has shifted dramatically and positioning accordingly. I have done this multiple times over my 80-year career. 2008 was the most recent major example, but there were others before. 1990, 1982, 1974. Each time, the pattern was the same. Yield curve inverts, recession follows, rates crash, defensive positioning wins. Then aggressive redeployment into cheap assets creates wealth. The pattern repeats because human nature and economic mechanisms do not change. Understand this pattern. Watch for the warning signs. Position your portfolio accordingly, and you will be prepared for what always happens before interest rates crash. Let me go even deeper into the mechanics of why this pattern repeats and share more specific historical examples so you truly understand the cause and effect relationships at work. Because once you see why the pattern exists, you will have much more confidence to act on it when you recognize the setup developing. The fundamental reason interest rates crash is that central banks, particularly the Federal Reserve, use interest rates as their primary tool to manage the economy. When the economy is growing too fast and inflation is accelerating, they raise rates to slow things down. Higher rates make borrowing more expensive, which reduces consumer spending and business investment. This cools the economy and brings inflation under control, but the problem is that monetary policy works with long and variable lags. The Fed raises rates today, but the full impact is not felt for 12 to 18 months. This lag creates a recurring problem. The Fed raises rates to slow the economy, but because the impact is delayed, the economy keeps growing for a while even as rates rise. This makes the Fed think they need to raise rates even more, so they keep tightening. Eventually, all those rate hikes hit the economy simultaneously. Spending collapses, business investment freezes, layoffs accelerate. The economy tips into recession, and the Fed, seeing the damage, panics and cuts rates aggressively to try to cushion the fall. This is why rate cuts come in bunches. The Fed kept raising until they broke something, and now they need to fix it fast. Let me walk through several historical examples in detail to show you how this has played out repeatedly. Start with the early 1980s. Paul Volcker became Fed chairman in 1979 with inflation running at double digits. He raised the Fed funds rate from around 10% to over 19% by 1981. This was the most aggressive tightening in Fed history. The goal was to break the back of inflation, and it worked. But it also triggered a severe recession. The yield curve inverted sharply in 1980 and again in 1981. Short-term rates were at 19%, while long-term rates were only 14 or 15%. This inversion was a clear signal that a recession was coming. And sure enough, the economy fell into a deep recession in 1981 and 1982. Unemployment hit nearly 11%, the highest since the Great Depression. Once the recession was underway, Volcker began cutting rates aggressively. From over 19% in mid-1981, rates fell to around 8% by late 1982. That is an 11-point drop in rates in less than 18 months. This was an interest rate crash, and it created enormous opportunities for anyone positioned correctly. Long-term Treasury bonds soared in value as yields fell from 15% to around 10%. If you had bought 30-year Treasury bonds in mid-1981 yielding 15%, you would have seen massive capital gains as yields fell, plus you collected that 15% coupon. Total returns were over 50% in some cases. Meanwhile, stocks were getting crushed in the recession, falling over 20% peak to trough. But here is where it gets interesting. After the Fed finished cutting rates and the economy stabilized, stocks began a massive bull market. From the bottom in August 1982, the S&P 500 rose nearly 30% by year-end, It tripled over the next 5 years. Anyone who bought stocks in late 1982 at depressed valuations and held for the rest of the decade made fortunes. The playbook was clear. See the yield curve inversion in 1980 and 81. Understand a recession is coming. Shift to treasuries and defensive stocks. Profit from falling rates in 1982. Redeploy into beaten down stocks at the bottom. Ride the subsequent bull market. Execute this correctly, and you could have turned $100,000 into over $1 million within 10 years. Now, let me fast forward to the early 1990s. The economy expanded through most of the 1980s after the early decade recession. But by 1989, the Fed was worried about inflation again. They raised rates from around 7% to nearly 10%. The yield curve inverted in 1989. 3-month T-bills were yielding over 9%, while 10-year treasuries yielded around 8%. Inversion. The economy held up through 1989 and into early 1990. Then cracks appeared. The savings and loan crisis was unfolding. Commercial real estate was collapsing. Iraq invaded Kuwait, spiking oil prices. The economy tipped into recession in mid-1990. Unemployment rose from around 5% to over 7%. The Fed responded by cutting rates from nearly 10% in early 1989. They cut to around 3% by late 1992. A 7-point rate cut over 3 to 4 years. This was not as rapid as the early 80s crash, but it was still dramatic. And once again, long-term treasuries rallied strongly as yields fell. Stock market bottomed in October 1990 and began a bull run that lasted the entire decade. The pattern repeated. Yield curve inversion signaled recession. Recession arrived. Fed cut rates aggressively. Defensive positioning outperformed during the downturn. Then aggressive redeployment into stocks at the trough captured the subsequent rally. The late 1990s and early 2000s is another textbook case. The Fed raised rates from around 4% in 1994 to over 6% by 2000 to cool the dot-com bubble. The yield curve inverted briefly in late 2000. The tech bubble burst. The economy fell into recession in 2001. The 9/11 attacks made things worse. The Fed cut rates from 6.5% in early 2001 to 1% by mid-2003, over 5 points of cuts in 2 to 3 years. Long-term Treasury yields fell from over 6% to around 4%. Once again, Treasuries outperformed stocks during the downturn. Then stocks bottomed in October 2002 and rallied strongly for several years. Every cycle follows the same script. Fed raises rates, yield curve inverts. Recession follows within 12 to 24 months. Fed cuts rates aggressively. Once recession is clear, Treasuries rally, stocks bottom. Then a new bull market begins. If you understand this pattern, you can position for each phase and compound wealth at extraordinary rates. Now, let me talk more specifically about the 2008 crisis because it is the most recent major example and provides the clearest lessons. The housing bubble inflated from 2002 through 2005, fueled by low rates after the 2000 to 2001 recession. Subprime lending exploded. Home prices soared. Everyone thought real estate only went up. But the Fed started raising rates in mid-2004. They went from 1% to 5.25% by mid-2006. This was aggressive tightening. And the yield curve inverted in early 2006. 2-year yields rose above 10-year yields. Classic recession signal. Most investors ignored it. The economy was still growing. Home prices were still rising. Corporate profits were strong. Anyone warning about recession was dismissed as a perma-bear. But I was watching carefully. The inversion told me a recession was coming. The housing market was clearly a bubble. Subprime lending was insane. The setup was there for a major crisis. I started raising cash in 2006. I let Berkshire's cash position build to record levels. I avoided buying stocks even though they looked reasonably valued. I bought long-duration treasuries. I positioned defensively. And I waited. The crisis unfolded slowly at first, then all at once. In early 2007, subprime defaults started rising. Bear Stearns hedge funds failed in mid-2007. The Fed cut rates from 5.25 to 4.75% in September 2007. their first cut. But it was too little too late. The financial system was already breaking. Through late 2007 and early 2008, the situation deteriorated. Bear Stearns failed in March 2008. Fannie and Freddie were taken over by the government in September. Lehman Brothers failed on September 15th, 2008. The entire financial system nearly collapsed. Credit markets froze. The stock market crashed, falling over 50% from peak to trough. The Fed went into full panic mode. They cut rates from 5.25% in mid-2007 to zero by December 2008, 18 months from over 5% to zero. That is an interest rate crash. They also implemented multiple rounds of quantitative easing, buying trillions of dollars of bonds to inject liquidity into the system. Long-term Treasury yields collapsed. The 10-year went from over 5% in mid-2007 to around 2% by late 2008. 30-year Treasuries fell from over 5% to under 3%. The price appreciation on long-duration bonds was massive. Anyone holding 30-year Treasuries through this period saw returns of 40 to 60% in a year, while stocks fell 50%. I sold most of my Treasuries in late 2008 and early 2009, locking in those gains. Then I redeployed that capital into distressed assets. Investment-grade corporate bonds were yielding 8 to 10% because of panic selling. I bought billions of dollars worth. Companies like IBM, Walmart, Johnson & Johnson issuing bonds at 8% yields. These companies were not going to default. The yields were absurd. I bought knowing I would collect those high coupons and the bonds would appreciate as spreads normalized. I also made several large strategic investments. Goldman Sachs preferred stock at 10% dividend with warrants. GE preferred stock. These were deals that were only available because the companies were desperate for capital during the crisis. The terms were incredibly favorable to Berkshire. Over the next decade, these investments generated tens of billions in returns. The stock market bottomed in March 2009 and began a bull market that lasted over a decade. The S&P 500 went from 666 at the bottom to over 4,800 by early 2022. Anyone who bought stocks in early 2009 and held made over 6 times their money, add in dividends, and you are looking at 7 to 8 times returns in 13 years. This is the power of the pattern. I saw the yield curve inversion in 2006. I knew a recession was coming. I raised cash and bought treasuries. I profited enormously when rates crashed in 2007 and 2008. Then I deployed that capital into distressed assets at the bottom. The returns Berkshire generated from 2008 to 2010 were among the best in our history, not because I am a genius, but because I recognized the pattern and executed the playbook. Let me now walk through the mechanics of bond math in more detail, because understanding this is critical to maximizing returns when rates crash. Bonds have an inverse relationship to interest rates. When rates fall, existing bonds with higher coupons become more valuable. The size of the price increase depends on the bond's duration. Duration is a measure of a bond's sensitivity to interest rate changes. A bond with a duration of 5 years will increase in price by approximately 5% if yields fall 1%. A bond with a duration of 10 years will increase by approximately 10%. A 30-year Treasury bond has a duration of around 20 years. If yields fall 2%, the bond price increases about 40%. Let me give a concrete example. Say you buy a 30-year Treasury bond in mid-2007, yielding 5% when it was issued at par value of 100. Over the next 18 months, rates crash and 10-year yields fall to 2%. Long-term yields might fall from 5% to 3%. That is a 2% decline in yields. With a duration of around 20 years, the bond price increases approximately 40%. Your bond that cost 100 is now worth 140. Plus, you collected the 5% coupon over 18 months, so about $7.5. Your total return is 47.5% in 18 months. Meanwhile, the stock market fell 50%. This asymmetric return profile is why I love long-duration treasuries when I see an inverted yield curve. The downside is limited. If I am wrong, and no recession happens, I still collect the 5% coupon and the bond matures at par. I might lose a few percent if rates rise, but that is my maximum loss. The upside, if I am right, is 30, 40, 50% returns in a year or two. This is a fantastic risk-reward setup. Compare this to stocks during the same period. If I own stocks and a recession hits, I could easily lose 30 to 50% as the market crashes. The downside is much larger. The upside, if I am wrong and no recession happens, is maybe 10 to 15% from continued market appreciation. The risk-reward is much less favorable. This is why I shift from stocks to long-duration treasuries when I see recession warning signs. The expected return on treasuries increases dramatically because rates are likely to fall. The expected return on stocks decreases dramatically because a bear market is likely. It is simple risk management based on probabilities and payoffs. Let me also talk about the psychology of investing through these cycles because it is just as important as the analytics. The hardest part of this strategy is having the courage and discipline to position defensively when everyone else is still bullish. When the yield curve inverts, the economy is usually still growing. Stocks are usually still rising. The consensus view is that everything is fine. If you start raising cash and buying treasuries, you look foolish. You are missing out on gains. You are being too conservative. I've been through this many times. In 2006 and early 2007, people questioned why I was sitting on so much cash when stocks were going up. They said I was too old and out of touch. They said the economy had changed and old recession indicators did not matter anymore. But I stayed disciplined. I knew the pattern. I knew the yield curve inversion was a reliable signal. I was willing to underperform for a year if it meant protecting capital when the inevitable crash came. Then when the crash happens, a different psychological challenge emerges. Everyone is panicking. The news is terrible. People are predicting the end of the financial system. Your treasury gains feel good, but now you need to redeploy that capital into assets that are falling every day. You need to buy when everyone else is selling. You need to act when you are scared. This is where having a plan matters. If you have studied the pattern and understand that recessions create the best buying opportunities, you can overcome the fear. You know that corporate bonds yielding 8% from blue chip companies are gifts. You know that stocks trading at single-digit P/E ratios with strong balance sheets are bargains. You buy not because you are fearless, but because you are disciplined and you trust the process. I also want to address a common concern. What if the Fed does not cut rates even when the economy weakens? What if they keep rates high to fight inflation? This scenario is highly unlikely based on history. The Fed's dual mandate is price stability and maximum employment. When unemployment starts rising rapidly in a recession, the employment mandate takes precedence. They will cut rates. The only exception would be if inflation was running at double digits like the early 1980s. In that case, the Fed might keep rates high even during a recession to break inflation, but this is rare. In most recessions, inflation is low or falling because demand collapses. The Fed has room to cut rates aggressively without worrying about inflation, so the pattern of rate crashes during recessions is very reliable. Another question people ask is whether this pattern will continue to work in the future or if something has changed. Some argue that with the Fed's balance sheet expanded from QE and unconventional monetary policy tools, the old relationships no longer hold. I disagree. The fundamental economic mechanisms have not changed. When the economy contracts, the Fed will ease monetary policy to support growth. The tools may be different, QE and forward guidance in addition to rate cuts, but the effect is the same. Easier monetary policy, lower rates, higher bond prices, the pattern will continue. Others argue that with so much government debt, the Fed cannot cut rates to zero anymore without causing fiscal problems. Again, I disagree. When the economy is in crisis, the Fed will do whatever it takes to stabilize the situation. They cut to zero in 2008 despite already high debt levels. They cut to zero again in 2020. They will do it again in the next crisis if needed. The debt concerns take a back seat to immediate economic stabilization. The pattern is robust because it is based on fundamental economic forces, not transient conditions. Business cycles exist, expansions are followed by recessions,
The Fed responds by easing policy during downturns.
This creates the rate crash. These relationships are baked into how modern economies function. Until we completely change the monetary system, which is not happening, the pattern will persist. Let me now provide more specific tactical guidance on execution. When you see the yield curve invert, what exactly should you do and in what order? Here is my recommended playbook based on decades of experience. Step 1, increase cash to 15 to 25% of your portfolio. Sell some stocks, particularly in economically sensitive sectors. Put the cash in short-term T-bills. You are earning a good return with zero risk while building dry powder for opportunities. Do this immediately when you see the inversion. Do not wait. Step 2, shift your bond allocation toward longer duration. If you own short-term bonds or bond funds, sell them and buy intermediate or long-term treasury funds. Focus on 10-year or 30-year maturities. These will appreciate the most when rates fall. Do not worry that they are yielding less than short-term bonds. The capital appreciation will more than make up for the lower yield. Step 3, gradually reduce exposure to cyclical stocks over the next 3 to 6 months after the inversion. You do not need to sell everything at once, but trim positions in financials, consumer discretionary, industrials, materials, redeploy into defensive sectors like utilities, consumer, staples, healthcare, REITs. Focus on companies with strong balance sheets, stable earnings, and dividends. Step 4, monitor economic indicators and Fed rhetoric closely. Watch unemployment claims, manufacturing PMI, consumer confidence, corporate profit margins. Watch for the Fed to start sounding more dovish. When you see these indicators deteriorating, increase the urgency of your defensive positioning. Step 5, when the recession becomes obvious and the Fed starts cutting rates, prepare to redeploy. This is the transition from defense to offense. Start watching credit spreads. When investment-grade spreads blow out to 200, 300, 400 basis points over treasuries, start buying high-quality corporate bonds. When stock valuations get to single-digit P/E ratios and dividend yields exceed treasury yields, start buying stocks. Step 6, be patient and accumulate during the crisis. Do not try to catch the exact bottom dollar cost average into positions over several months. Use limit orders to buy stocks and bonds at specific prices. Let the market come to you. You have cash, you have time, you can be selective. Step 7, once you have redeployed most of your cash and the market has stabilized, hold your positions for the recovery. Do not panic and sell if there is a second leg down. Recessions create double bottoms sometimes. Stay disciplined. The recovery will come. Your patience will be rewarded with multi-year bull market returns. This playbook is not complicated. It does not require fancy algorithms or high-frequency trading. It just requires discipline, patience, and the courage to act contrary to the crowd at key moments. Raise cash when others are greedy. Buy when others are fearful. Simple but not easy. Let me share one more historical example to reinforce the pattern. The COVID crisis in 2020. The yield curve had inverted in 2019. The economy was showing signs of slowing. The Fed had already started cutting rates in mid-2019 after raising them through 2018. I was building cash through late 2019 and early 2020, expecting a recession at some point. Then COVID hit in February and March of 2020. The economy shut down virtually overnight. Unemployment spiked from 3.5% to nearly 15% in 2 months. The stock market crashed, falling 35% in 5 weeks. It was one of the fastest crashes in history. The Fed responded with overwhelming force. They cut rates from 1.5% to 0 in a matter of weeks. They implemented massive QE, buying trillions in bonds. They created new lending facilities to support corporate credit markets. This was an interest rate crash combined with unprecedented monetary stimulus. Long-term treasury yields fell from nearly 2% to around 0.5%. Bond prices soared. Meanwhile, corporate bond spreads blew out. Investment-grade spreads went from 100 basis points to over 400 basis points at the peak of the crisis. High-yield spreads went from 400 to over 1,000 basis points. This was panic selling, creating massive opportunities. I deployed Berkshire's cash into the crisis. We bought stock in several companies we liked at distressed prices. We bought corporate bonds yielding 6 to 8%. We made strategic investments in Japanese trading companies that were undervalued. Then we held as the market recovered. By the end of 2020, the S&P 500 had fully recovered and was hitting new highs. The bonds we bought appreciated significantly as spreads normalized. The strategic investments we made generated strong returns. Once again, the playbook worked. See the warning signs. Position defensively. Deploy into the crisis. Hold for the recovery. I want to emphasize something important. This strategy requires patience and discipline, but it does not require you to be right all the time. Even if I am wrong about the timing and the recession takes longer to arrive than expected, my downside is limited. I am holding cash earning 5%. I am holding treasuries collecting coupons. I am holding defensive stocks paying dividends. I am not suffering. I am earning reasonable returns while positioned for protection. And when the recession does eventually arrive, I am ready. I have cash to deploy. I have a plan for what to buy. I have the psychological preparation to act when others are panicking. This preparation is what allows me to capitalize on the opportunity when it presents itself. The alternative, staying fully invested in risk assets through the cycle, means I enjoy the late-stage bull market gains but then suffer devastating losses in the crash. Maybe I make 20% staying invested through the last year of the expansion, then I lose 40% in the crash. Net result, I am down significantly. With the defensive strategy, maybe I underperform by 10% in the last year of the expansion by being too defensive, but I avoid the 40% crash and I redeploy at the bottom. Net result, I am up significantly over the full cycle. This is not market timing. This is strategic risk management, and it is based on one of the most reliable patterns in all of economics. Yield curve inversions predict recessions. Recessions lead to aggressive Fed rate cuts. Rate crashes create opportunities in bonds and eventually stocks. The pattern has repeated for 70 years. It will repeat again. Understand it, watch for it, position for it, and profit from it when it unfolds.